Ken Shinoda joins us right now, portfolio manager at DoubleLine Capital. And Ken, it's been quite a ride for markets, really, when you go back to 6 weeks ago in that last Fed meeting, an S&P that continued to rally. We briefly saw long-term yields above 5%, short-term yields above 4%. Based on what we learned today, I am curious as to where you see the direction right now for yields, particularly on the short end of the curve.
Yeah, well, we're kind of in the middle of the trading range. It's funny. I had a call with a client who was asking about, how high rates have gone, and the 10-year has kind of been in this trading range, kind of 380 on the low end, up in the high fours, close to 5 on the high end, and we're kind of right in the middle of it. So with the Fed on hold, I think, I'm kind of neutral on long-term rates. I'm negative on the long end because of fiscal risks. So I think the 10-year is kind of a neutral view here. I'm not too bullish. If we get up back towards that kind of 4.75, 5%, maybe that's more of an interesting buying opportunity. But I'd rather hug the front end of the curve right now. I think you can find a lot of opportunities off the 2-year. Some short, high-quality credit where you pick up 100, 150 basis points over the 2-year, and that's a great place to hide out and wait for a better buying opportunity.
I am curious about the differential between what we're seeing with the Fed funds rate and what we're seeing in the secondary market. I mean, there's not a big differential there if you just take, obviously, the benchmark 10-year at, like 4.3869, and you have a Fed funds rate kind of right in that spot. Does that mean that the markets and the Fed are aligned, or is there a mismatch there that we should be paying attention to?
Well, the market thinks the Fed's gonna cut. I was actually kind of surprised that they kept the dot plots as is. I thought they would be a little bit more hawkish given the spike in oil and the geopolitical concerns, the tariffs. But I think what they're signaling to the market is that, the dual mandate that Powell talked about over and over again today, which is obviously keeping inflation down and keeping unemployment up. It seems like he's more concerned about unemployment, and that's why he wanted to keep those 50 basis points of cuts on the table today.
Ken, you brought up Iran for a second, and you were talking about not loving the long end of the curve. Does that mean that the Treasury market right now can't really be that safe haven asset that we're used to?
Well, it's held at 5%. We had a couple of weeks of the fiscal fears out there, but I think the geopolitical tensions are helping yields come down a little bit here, and that's why we are kind of at that 480-ish level on the long bond. We're sub 4.5 now on the 10-year. So it's one of those things that it'll work if growth slows down, but to the extent that growth doesn't slow down and fiscal fears continue, then I think you can see a continuing steepening of that yield curve.
What about the credit market? How much risk do you want to be taking on when volatility could really pick up in the equity market and could spread if we have continuation of disturbance in Iran and Israel?
Well, we had been upgrading our portfolios for the last couple of years in hopes of a little shakeup, which it looked like we were about to get in April. And we saw some spread widening, but the fixed income markets and the credit markets in particular were way more contained than you would have thought of if you looked at price action equities. We had those couple of days when stocks were down about 5% a day. And while we did see high yield spreads widen, they widened from very tight levels to about average. And so we never really got that dip buying opportunity for any meaningful period of time. And spreads have recovered with the equity markets. I mean, investment grade at its tights at the beginning of the year was about 76 basis points. It's got to 120. Now it's back to 85. High yield had a 250 handle. It got to about 450, and now it's at 300. So you're kind of almost back to where you were at the tights. So it's not really a great buying opportunity. So I'd rather be up in credit, upgrade portfolio quality. Again, that short end of the curve, you can go into the securitized markets, buy things like asset-backed securities and some commercial mortgage-backed securities, find some attractive spread there, but stay short, hide out, and wait for some things to come.
I have to get your thoughts, though, Ken, on what's been going on in the housing market. And Powell, he didn't address this directly today, but he's talked about it in the past as how that's a huge component of what they're paying attention to. We've had a couple of data points this week showing deterioration in the market, certainly the housing starts today and the home builder sentiment from the other day. As an investor in the residential market, I am curious as to whether that works in your favor or whether you now take precautions.
Well, if you're looking at government-guaranteed agency mortgage paper, its supply will be down because people aren't buying homes. But you're not really worried about defaults because those agencies, Fannie, Freddie, Ginnie Mae, they buy out the loans at 100 cents on the dollar. And if you're a credit investor, you're always watching the housing market. Is the housing market going to go up? Is it going to go down? And obviously, if home prices go down, that could be bad for you if you own mortgage credit. But underwriting quality is so high right now, and I think the home prices can soften. Regionally, they could go down just because supply is finally increasing and people have just given up to try to buy with mortgage rates so high and affordability low. So I think you'll see some regional softening, but I don't expect a deep decline nationwide. And with mortgage underwriting quality so high, it's not really a worry for mortgage credit.
All right, Ken, always appreciate you jumping on a day like today. Ken Shinoda, DoubleLine Capital Portfolio Manager.